And welcome to another edition of the Nerd Agent Podcast. I'm your host, Luke Pedersen, with my brothers and fellow nerds, Josh and AJ. We're all here today. Whoa. We're all here today. Did you hear that?
First off,
this morning.
This episode is brought to you by Black Raspberry.
Are you not saying? Are you not
I'm not
saying
going to say the name of the brand. It's really, really good though, you guys. You should try it. It's in
You
the
know
office.
what? We are in downtown Hopkins. Hopkins is known for the Hopkins Berries Town Ball team, who got to the round of 8 this last summer,
And the Black Raspberry Festival. The Black Raspberry Festival.
The Raspberry Festival. So congratulations to the Vikings for now being 4-0, the best team in the NFL, best defense, and Sam Darnold, who is the same age as Joe Burrow, but also a little bit younger. And congratulations for the Minnesota Twins for clinching their spot as the last wild card. We're excited to watch
This
you
episode is going to
in
be
the playoffs.
so sad when it actually gets
We're
dropped.
excited to watch you in the playoffs.
I'm just glad everyone's got
week.
the, you know, you have podcasts, you get the 30-second skip, right? Where it's like every time a commercial comes on, you just skip ahead 30 seconds. At least
Skip
folks
the
can do that for all of our
beginning. They can
intros.
skip the beginning.
Just
This week-
you won't suck me in. Just remain
Nope.
dead inside.
No, neutral. Just neutral.
I'm excited to win a Super Bowl this year and an NBA title, but I'm gonna be blown away when we also win the World Series.
I will say I
Wow.
cannot be neutral in the Timberwolves. When they show up, I'm fully in the tank there.
Yeah.
I'm
They're
a
gonna
10 out
win
of
the
10
whole
for
thing.
excitement for them.
This week, we're going to talk about the meeting the Fed had last week, the cuts that were made, how that affected things, what they talked about. To start, can you give just a high-level overview of what they talked about at their meeting, what the cut was, and then what was said post?
50 basis points. That was the big headline.
And what does that mean?
50.
Let's just
That means
re-talk
mortgage rates
about that.
dropped 50
No,
basis.
don't say that.
Just kidding. It's the biggest misunderstanding that we have as
In real
agents. We've
estate.
spoke about this a number of times.
Let's talk about
So
what
if you're
the 50
listening, if
basis
you're listening
points
to
mean.
this, you know that isn't how it works. The 50 basis points is the overnight rate, so they guided it down into the I think 4.75 to 5 range. And so it is good news that we're starting to see that come down, because while it doesn't directly, flow through to mortgage rates, indirectly there's a correlation there that as that rate comes down, we'll see mortgage rates tend to move the same direction.
And one thing you could talk about with folks, though, because I just had a conversation with a guy yesterday who was doing a HELOC on his house to do some construction. That is immediately impacted by the overnight rate coming down. So you'll start seeing credit card rates come down immediately.
Yep.
They're not impacted until that rate drops. You'll even start seeing short-term car loans come down, but any interest-only payment will start dropping, as well as anything you have invested in, like money markets and things like that. Because
you're going to get less.
You'll get less.
Yeah, because
Yep.
banks have this concept called cost of funds, right? So it's like, how much does it cost inside the bank to pursue transactions, move money, et cetera? That's tied directly to this overnight rate. So as the overnight rate comes down, the cost of funds come down. All of the different components that go into interest rates in a variety of places will move accordingly.
It's referred to commonly as, it was once the LIBOR, the London Interbank Offering Rate, and now it is called the SOFR, which is the Secured Overnight Financing Rate, I believe, or funding rate.
But like, we have commercial loans, and those are directly tied to, they're higher because the bank has higher cost of funds. So then those tend to be higher than the residential rates right now.
And they're shorter term.
Yep. So those will likely be moving down as this continues to move down, but they're already inflated. So the residential rates, though, as we mentioned, are tied to the expectations of what's going to happen on this rate. So we've already seen them move down, and ironically enough, we had the 50 basis point cut, but then an increase in mortgage rates on the same day.
By about 10 basis points over the
And why do you
rest
think
of the week.
why do you think that happened?
The mortgage market already had baked in the 50 basis points of cut, or they've baked in all the future cuts that are presumably going to happen.
I think it was also, we talked about Powell, right, and what he said, but there were certain things said that suggested, like, we're going to continue to evaluate this and move this down, but the economy feels strong. The job market feels strong. The inflation numbers feel a little in check right now. So he kind of does this every time, where he'll do one thing in terms of the action and then try to speak out of the other side to minimize the impact being too drastic one way or the other. And so I think people also responded to the comments in a meaningful way in terms of where it's guiding future expectations for them. And that put a little bit of a pause on, a massive run, which would have probably resulted in more declines within the mortgage rates.
I wonder if he has had to change his strategy since I mean, obviously he's been doing this
100%
for,
he has.
how long has he been doing this? For a long time.
This is his 1, 2, 3, like fourth administration. Is that right?
So because
Yeah,
when
he's been all over,
because he
yeah.
was the one who kind of got us through the recession in '08, correct? He
No.
was a part of that.
he was right. He was
just
well.
after that.
He was a part of the group, but he was not the president at the time. I
Correct.
don't
Wasn't the
think.
president.
No, he was
I'm just
not.
curious because
Bernanke.
back then they probably just were like, oh, we're gonna cut it to this or we're gonna raise it to that, and then it didn't. That's like just kind of affected it. But now it's like every time he talks, it feels like everybody on social media everywhere knows he's speaking. And so it's not even just what they do; it's what he says that matters a lot.
Well, and keep in mind, in 2008, like Facebook just became a thing. There wasn't even you couldn't even watch it unless you turned your TV on to the channel.
We didn't have Twitter or Instagram, did we?
No, I don't think so.
No.
Yeah, it was very different. But I think we've talked about this before, but generally speaking these days, with everything, it's not just this, but like the pace at which things move around is much more, there's more reactiveness. I mean, in ideas, in beliefs, in the stock markets, et cetera, because of the vast availability of information. Everyone's just moving faster. And so things are changing really, really quickly. I think I've given Powell kudos in the past because I feel like he has done a very good job of trying to basically say, like, here's the action we're taking, but let's not overreact. Let's not overreact. And he's, on both sides of the coin, really done a good job of trying to minimize massive swings or overreactions. And anytime that there's been overreactions, he's kind of found a way to course correct pretty quickly.
He's kept the derivative low, really, is what I would say for all those calculus fans out there, which is basically the momentum, right? So, like, if he would have overreacted and said, 50 basis point cut and the economy sucks and
We're really worried.
then it would really, really tank fast. But he tries to keep the momentum at like a low level, but change the direction of it, but then keep it muted.
Do you imagine being able to swing the markets with one sentence?
Oh, it's crazy.
It's like parenting though, right? Like you're always kind of just like trying to like slowly
Stay
course
neutral.
correct, stay neutral.
Isn't he not? He's not allowed to have any stock holdings. I don't think.
I'm sure not. There's no way.
Him and Tim Walz.
The quote I have on here is, we're not saying mission accomplished, but I have to say, though, we're encouraged by the progress that we have made.
Yeah,
It's like, that's the most neutral statement.
It's
I've
like how
ever
AJ and I
heard.
feel about the Vikings right now.
Oh my gosh, they're the best team.
No, I would be tanking them immediately.
Stay
I'd be
neutral.
tanking them immediately.
No, don't overreact. Just it's neutral.
Moving forward, there are some predictions as to what they're going to do at their next meetings as far as cuts go or no cuts. What does that look like?
I mean, they've said they're going to continue to cut, and I think Josh, you gave the number of what they're looking to get to by the end of this year. Was it low fours?
I think it was 4.25 to 4.5 was the goal by
which
the
would
end
be
of this year.
2 more quarter point cuts.
Which would be their next two meetings. So they're November and December, right? So
Which would be about right.
that's what we'd expect. So once again, though, to everyone out there listening, don't anticipate that will bleed through to mortgage rates at this point in time. We probably actually will see maybe more activity kind of flowing into the meetings than directly after the meetings in terms of where rates are going. It does seem like rates will continue to kind of have this downward arrow on them into the future. How significant of a downward arrow, though, is to be determined. And I would not be advising clients that we're going to see a massive cut in interest rates in the near term because it is an uncertain enough environment right now that we do not know that is going to happen.
And you know what? I actually think we're better off if we don't. Depending on the market, and we're in the Twin Cities right now, and so we're working in a marketplace that's been strapped for inventory for
Depends
a
on
long
what you mean by
time.
don't. Like how low are you talking about?
Well, like if they had just jumped to like 5.5 or 6 overnight last time, it would have maybe made the market harder for most buyers.
I think our best case scenario is a slow guide down into the mid fives and then a stabilization there.
But if it
because
was
you're
like
close enough then
overnight-
to encourage sellers to move out of their rates, which is going to boost the supply side in a way that's going to boost the market. And you're going to have enough buyers that are going to want to be active there. But if the supply side comes out, that'll minimize the impact of maybe the extra buyers that are coming out that weren't out prior.
And we already have more supply in the Twin Cities than last year by like 15%. And a lot of markets have 40% more inventory than last year.
So they might be ready. That's what I'm saying. 40% more, you might be ready for something like this. But even we're at what, 10 to 15% more?
Yeah.
Pretty consistently. And then these are all micro scenarios, but I'm in multiple offers like every weekend.
yeah, I just lost 2 weeks in a row.
So we're talking about more inventory.
price points, too.
Debatably of houses that maybe aren't as nice, is what I'm wondering we're seeing. So we're seeing more houses
Correct.
sit on the market that kind of stink, and then all of the nice stuff is still moving because there's just not much of it. And so if rates go to 5.5 and the people that own those houses still aren't moving because their rate's 2.75 or 3, it's just going to be a mess again.
I do think, though, the difference between 3 or 3.25, where people are at, and 5.5 is going to be close enough where it might be viable,
Hopefully,
to no longer live a little uncomfortably, especially because they've been holding uncomfortably for years now, right?
Mm-hmm.
So there's been a couple of years in which they've been like, well, I can't go to 7. That doesn't make sense. I can't go to 8. That doesn't make sense. But I don't like my situation. I wanted to move 2 years ago. 5.5. Okay, yeah, I can test the waters.
You know, one fun fact I talked with you guys about that I actually just sleuthed around on our back end tax records is BlackRock, who owns a bunch of single family holdings here in the Twin Cities, and they own Home Partners of America, which has a bunch of contract for deeds.
that's
has
new.
started
When did they start owning that?
2021, and they started selling. And again, I don't know what the exact numbers are because I'm just working off of it based on the website that they post their listings on now. But all time, they've only closed like 30 or 40 on this website on our MLS. And right now, they have like 40 active and like 30 or 40 pending out of the 1,600 that are owned within those companies. So kind of fascinating to see because what's funny is they have all different names for all the owners, but they're all either SFR, which stands for single family rental, or HPA, which stands for Home Partners of America. I think the CDs, they have like 700 listings, which would actually have a decent impact on our market. It's like 7-8% of the inventory right now. And a lot of them are defaulting because they went into effect in 2019, which would have been a 5-year CD, or 2021, which would be a 3-year CD, when the rates were 3% or 4%, and they were anticipating being able to refinance those in the end of the term with a 3 or 4%. And now that the rates are 6, they can't afford it.
And they haven't really, if you bought it in 2019, you probably have some equity, but they haven't, I've looked at these listings, right? Because you sent these to us. They bought like pretty put together houses. They weren't really making huge changes or adding value to the properties. And so I'm curious what their basis is on
Well, I
those
think,
too.
we're in the rental game here locally, too, and we have not seen rental rates rise as fast as we've seen other components, and we've seen cost of labor, cost of renovation, cost of fixes increase. So, I haven't sold many homes to my investors lately because, A, the math doesn't chalk very well because the rental rates aren't exceeding the mortgage payments very often. And B, there's no guarantee of future equity the way that there was, not guarantee, but there's less of a shining star around equity than there's been historically. And the cost of holding them is even higher than it's been historically. So it is possible that what was a very, very solid investment for a company like BlackRock back in the COVID time when they were just getting growth and rental rates felt like they were going to keep going up forever, has stabilized or come down in a way where they're not seeing it as the same level of quality of investment, which could lead to some sell-off. It's a bit of a stretch hypothesis, but
Are you guys hinting at the fact that we're smarter investors than BlackRock?
I don't know. I don't think so.
I don't think so either.
I'm kidding.
We're on a micro level maybe, but not on a macro
I'm
level.
kidding.
But it'll be interesting to see if any of that stuff where maybe people are reevaluating residential real estate as a massive part of their portfolio, because it felt like for a while it was like a no holds bar, let's just buy as many homes as we can for a lot of these large scale investors.
I wonder how many other investors in the cities have those types of loans that would be coming due. Probably not as many. They're mostly larger.
The commercial ones are all like that, and a lot of them are coming due. In fact, a downtown Minneapolis commercial building, which sold, I want to say 3 years ago for $90 million, just resold for like 8 or 9.
I saw that.
This year.
The commercial stuff for sure. The commercial buildings are getting smashed, aren't they?
Yeah, and I think there was like not only overvaluation, but then also, probably prompted by the fact that everything was going so well, but also because those rates were just so low. Maybe they were getting an IO loan at 2% on it, and it really, really worked. And now you're looking at it going, oh shoot, they're not even offering that, and the rate's 6 or 7 or whatever it might be. So you're seeing a lot of those valuations start to drop, and that's what a lot of people have been super focused on. I talked with Alex about that, about how people are extremely concerned with the banks because of that sort of thing. Because if you have a $90 million purchase and they owe $70 million and the property's worth $10 million now, not only is the borrower going to get foreclosed on and get kind of screwed from a credit perspective, but the bank's now stuck with a $60 million backwards,
which is a ton.
piece of
100%.
property, you know?
So yeah, the only thing I'll leave you with on this final note is it does feel a little bit like we're in a kind of I tell people there's like these little arbitrage windows when rates might jump down fast, but the buyer pool hasn't necessarily come on the same pace. And I don't know that you guys have felt it the same way, but once again, this is very like micro my experience, but I haven't seen a drastic change in buyer activity as a result of the rates going down roughly a full point, right? So in the spring, I anticipate, or even come January, especially if rates continue to fall, I do expect the market to get really competitive again. But if you're looking at buying and you're in this time frame right now through the end of the year and rates are starting to come down and you can get into a house without competing the same way, it may be really advantageous to be buying a house. So that is something that if you have buyers that you've been working with, or if you're like on a lead-based team and you can pick up new leads, you can utilize to your advantage to help people get some wins and help sell some houses in the fall. Because I do think that while it's not still the best time ever to buy a house, I think comparatively to what you're going to experience 3 months from now, 4 months from now, it's really advantageous on the buy side compared to where it's been.
It's going to be really difficult. And that's all we have for this week on the Nerdy Agent Podcast. And as always, remember, be better